Good morning, Andy. Welcome. And how are you?
Good morning, Anil. How are you? So I'm
Brilliant.
I'm very well,
Great.
and looking forward to this. Although I feel that my presentation might be redundant after just listening to Tony. So if you're looking for me for a dose of optimism, maybe best to turn off now.
Not a problem. I'm sure you'll give us some interesting nuggets that we can focus on and carry into the new year. So, Andy, I'll just hand over straight to you then. Take it away. Thank you.
Okay, thank you very much. Okay, well, I think it's still morning in South Africa, so good morning, everybody. I'll crack straight on given time. So this is I was asked to do a market review of Q4, but we're very long-term investors, and so I thought it was better to try and put the current market into some sort of perspective. And so this is actually, and obviously you can get these slides. This is worth reviewing afterwards because it's quite a lot of detail on here. But these basically show the best performing sectors by year going back to 2012. And as you can see in the recent past, so if we go, well, actually, but for every single year, IT has performed better than the market. So for all of those years, IT has been one of the best performers, even interestingly, when the market has declined. So for example, in 2015, markets were down a bit. And as you can see, IT outperformed, and the same in 2018. So technology has been on this amazing run. Interestingly, for the best portfolio over the last sort of 4 or 5 years, you would have had to chop and change a lot, with the exception of IT. So if you've held IT throughout and had a high weighting, then obviously you've done very well. But you've had to change hugely from 2017 being very economically sensitive, so materials, consumer discretionary, industrials. 2018, you actually wanted to hold healthcare, utilities as the best performing sectors. 2019, back to economically sensitive with industrials, consumer discretionary. 2020, IT again, consumer discretionary. And 2021, very interesting. So after energy has dominated the worst performing sectors for a long period of time, obviously, lack of investment in energy infrastructure, together with increasing demand, has led to a very substantial increase in energy price. And so energy doing well, financials doing well, with the expectations of yield curve rises, I suspect. But interesting to see how things have changed over a long period. And now to try and put some perspective around it. So there's three charts on here. The top left just goes to show that since the global financial crisis, so this goes back to 2010, what we've seen has been a huge re-rating. And this was what Tony was talking to, with the amount of liquidity that's been put into markets by central bankers, particularly Fed and the ECB. And so, as you can see, the black line is growth in the Fed balance sheet. This is actually just the US, top left, but it's indicative of what's gone on across the world. And then you can see the PE valuation in red of high quality companies. And as you can see, they've gone from 15 times all the way up to 25 times. Currently, we're actually a bit higher than that now, so nearer 26 times. So we've seen this huge re-rating going on because we've got huge amounts of liquidity, we've got interest rates very low, and that's led to this idea that there is no alternative, TINA. So people have had to put money into equities in order to get yield, and a lot of that money has gone into these high quality companies, which is what we tend to focus on. The chart at the bottom left just tries to show that this valuation discrepancy a bit for the MSCI World. So usually the red line and the black line, the red line being EPS growth on a 3-year basis, and the black line being total return on a 3-year annualized basis. Generally, these move pretty closely together. So stock prices over 3 years tend to move in line with the growth in earnings. But as you can see more recently, if you look at the right-hand end of that chart, that they've actually diverged quite a bit. So we've seen stock prices rising, but actually earnings haven't been that strong on a 3-year annualized basis. So that kind of X's out the COVID impact to some degree. Obviously, we had a big decline in earnings in 2020, followed by a very rapid rise in earnings in 2021. So it's kind of X'd out that bit in the middle. But as you can see, valuations have continued to increase, but earnings have been fairly lackluster. And then to try and put it into a very long or longer term context, the chart on the right hand side is again just the US because the data is easier to get, but it's symptomatic. And I would actually X out the decline that you see right on the right hand side, so the COVID decline of 34% that you can see bottoming on March the 23rd, 2020. That was obviously abnormal, caused by COVID. And the recovery was very quick, largely Fed induced or central banker induced. But if you take the end of the global financial crisis to December 31, 2021, what we see there is almost a 17% annualized rate of return for the S&P 500 over 13 years, which is a huge bull market. I mean, this is in the context or in the same league as the bull market of the 1990s that ended obviously with the TNT bubble. So the backdrop has been that we're operating in is the backdrop is a very robust equity market, very high valuations. It's been a long bull market. And normally that's a time, as Tony was discussing, to kind of think about being a little bit more cautious and circumspect. And it's not necessarily to say markets will decline and we'll have a crash, which we have no idea about. But it does say that the likelihood of having these sorts of returns continuing for a 5 to 10 year horizon, so annualized returns from here over the next 5 to 10 years, are highly unlikely to be in the same league as the 16% return, 16.5% return that we've had since March 2009. So we should expect much lower returns. It's what bond yields are saying, looking forwards. Now, in terms of the portfolio, we've obviously had quite a difficult 12 months. We're pretty cautious, and so we've underperformed the rapidly rising market, as you can see here. I mean, we tend to focus on 5-year performance. We're obviously long-term investors. And our aim, as I think, and I certainly hope everybody realizes, is we have a dual mandate for our clients, which is that we aim to outperform the equity market over a 5-year horizon, but we also aim to deliver good absolute returns. And so we have this dual benchmark, and we know that it's most difficult for us to outperform the equity market when it's rapidly rising. So this kind of 15% a year or more, it gets difficult for us to outperform because we start to become cautious at some point. So as you can see, over 5 years, we have underperformed the market by about 88 basis points annually. So we've done 14 and a bit against 15. We feel we've met our absolute return targets in this environment, which is one thing that we are hugely focused on. And obviously what we're aiming to do is to ensure that we can deliver absolute returns over a 5-year horizon going forwards. And I think that will be a lot more difficult for equity markets as a whole, given the starting point. Now, in terms of this is a very busy slide, so feel free to review this. But this is just the 3-month performance. I mean, we pay very little attention to 3-month performance internally. But in terms of attribution, if you look at the very right-hand column, which says total effect at the top, the 3 areas that have cost us over this period is IT, industrials and cash. So we have a bit of cash in the portfolio, and obviously in a rapidly rising market, cash is painful. So that's cost us, probably the easiest to explain. Information technology has cost us in the 3-month period because we have a very low weighting in IT compared to the index. And so as a consequence, with IT again being the best performing sector over the last 3 months, or the last 3 months up to 31 December, it's led us to underperform because of our sectoral weighting. Now, the reason we have a low sectoral weighting in IT is simply valuation. The valuation of IT companies is extremely high. And so as a value disciplined investor, where we seek absolute returns over the long term, it's really hard for us to find suitable IT companies that meet our requirements. And then the other area that's underperformed is industrials. That's largely related to Omicron. Most of our industrials exposure is related to aerospace. Omicron, obviously, during Q4 led to declines in anything related to aerospace or travel because of worries over how virulent Omicron would be. That's beginning to reverse in Q1 2022. But that's the reason for our underperformance over the 3-month period in industrials. So in terms of market outlook for 2022, I haven't got a huge amount of positive things to say, which Anil encouraged me to be very positive. We do think that it's very likely that COVID becomes endemic in 2022. We've spoken to a lot of virologists recently. There's a bit of debate between them, but in general, they think it's possible that coronavirus mutates, has one more serious mutation during 2022. But there's a good chance that if there is another mutation, it has to become more transmissible, and so very likely it will become less virulent. So maybe we have another variant, but if they're becoming less virulent, then probably we can return to some sort of normality anyway. Vaccines are likely to continue, so we'll probably have an annualized vaccine program from now on. And so if we're right that this does become endemic, then things like travel are likely to return to a much closer to 2019 run rate sometime by the end of 2022, which would be very positive for actually some of the areas of the market that have been poorly performing recently, like travel, so aerospace and travel, hotel groups, etc. The negatives for us, though, are pretty wide. Growth, margin, inflation, valuation, liquidity, and geopolitics. Now, I know Tony spoke about some of these, so I won't talk too much about liquidity. Obviously, the Federal Reserve have pumped a huge amount of money into, or all central banks have pumped a huge amount of money into markets. Growth is interesting because 2021 obviously was very high growth. People are expecting that to continue, but there are quite a few risks to growth. I mean, probably the largest risk to growth is that government spending is likely to decline. And so all these governments that have been running huge deficits during 2020 and 2021 are likely to rein those in during 2022. And as I'm sure the economists amongst you realise, the identity is that any deficit in government spending must be balanced by consumer incomes, business revenues, and/or there's a smaller amount that relates to foreign income. But it's an identity, so those two things have to basically add up to zero. And so as government spending declines, it likely means that either business profits or consumer incomes will come under pressure. And I struggle to see how consumer incomes come under pressure when we've got inflation running at 7% in the US, 5 and a bit% in the UK. So we've got this high inflation. So we'll come to some of those in a little bit more detail, but we think there are quite a few negatives out there. And so our focus is clearly on generating absolute returns. 5-year horizon and absolute returns is what we're aiming to achieve. So in terms of the portfolio and what that means, these are the current holdings within the portfolio. We have a number of, all the companies in here are hugely cash generative. We think they all display a significant amount of value. So, taking some examples, Chartered Communications, second biggest position. We think by 2025 has something like an 11 or 12% free cash flow yield. CVS Health currently has an 8% free cash flow yield. Unilever, huge 5.5% free cash flow yield. BAE Systems currently on an 8% free cash flow yield. Even things like Meta and Alphabet have actually quite high free cash flow yields and are growing extremely quickly. So we think we have quite a reasonable amount of value within the portfolio. In terms of sectorally, again, we have areas, healthcare, where very stable demand, communication services, stable demand, consumer staples, stable demand. Where we're underweight, obviously, is information technology due to valuations, and industrials, where our exposure is twofold, but it's in infrastructure assets, which generally have very stable demand, so things like airports and toll roads, and also in some aerospace specific exposure. So if we're correct that actually Omicron becomes endemic, travel starts to return to normal, then it's very likely that these areas will do well as they see demand returning, even if the market is difficult or we see other areas that are economically related performing poorly. So we feel like the portfolio is in good shape. Just turning to some of the risks. So first one on margin. So this is the left-hand side is, again, apologies for the S&P data, but it's S&P margin. It is replicated across the world, but it's most stark in the US. You can see that margins are at all-time highs. Well, this only goes back to 92, but 13% I think is an all-time high. They're not really mean reverting, as people say. They're on a gently upward slope because we get a greater proportion of high-tech companies with obviously higher margins overall. But they are very, very high compared to recent past, and we would expect that they're likely to decrease over time with inflation taking a bite. And that inflation is likely to come from the right-hand side for companies. So we're going to see the labour share of revenues increase. So we think labour will start to take more, and that will lead to some pressure on margins over time. And we think that that's what's happened over probably the last 10 plus years is inflation has been so low, so workers haven't had the opportunity to ask for pay rises because you can't, in a 1% inflation world, it's hard to say my costs are going up, but in a 7% inflation world, rest assured workers are going to ask for pay rises, and we're already starting to see that come through with a lot of CEOs talking in their results at the moment about wage pressure. Inflation, I know Tony touched on this. Left-hand side is inflation. This is US, obviously 7% currently, core inflation rising. Middle chart shows PMIs, so this is Purchasing Managers Index, input and output prices, again, rising rapidly. And what we find difficult to understand, and I'd love it if somebody could explain it to me, is how bond yields, which are on the right-hand side for the US, can be so low in this environment. I mean, basically what this is saying is that the bond market thinks inflation will return to 2% or so looking forward, and that's exactly what the forward 5-year, so the 5-year forward break even says that we're going to 2%. Now that may not be the case. I mean, it's got a terrible predictive record. So we would say inflation is potentially a risk at this juncture, and it's particularly a risk because most people are sanguine about it. And that's what makes it a risk, is that it's not being priced into markets in any way at all with bond yields where they are. Obviously, if inflation rises and is seen to be rising in bond yields, those bond yields will have an impact on equity valuations, which is just the last slide I've got. So this goes to why we have some concern over equity valuations. The top left is a measure of, this is Warren Buffett's favourite measure for what it's worth. So it's non-financial market cap over gross value added, GVA, going back to 1947. As you can see, it's off the charts. The one below is basically a risk premium model. So it shows the margin adjusted PE, and it's a reasonable fit for future returns. And as you can see at the bottom of that chart, it implies that future returns are likely, these are 12-year returns, are likely to be -5% annually. Obviously, that seems a bit much to us, but it's been good direction in the past. Top right is, you'll all have seen before, the cyclically adjusted PE, now at 40 times, near its peak in 2000. And also the bottom chart here on the right-hand side is actually quite instructive. So this is, if you take the cyclically adjusted PE, which is on the bottom there, the Shiller PE ratio, and then you look at the subsequent annualized S&P returns for the 25 years from 95 to 2020, so these are 10-year returns, there's a very good line of best fit, which just goes to say that actually valuations are pretty poor in the short term about predicting where markets go, but actually they're pretty good in the long term about predicting your total return. Now, today's cyclically adjusted PE, Shiller PE, would imply that your average return on the S&P over the next 10 years will be about 0. So obviously, market valuations today very high, and to us that would imply a risk going forward, and one we're looking to protect against. And so with that, I will leave it there. I'll leave it on this slide for people to read in case Anil wants to ask me any questions in the last 42 seconds.
Okay, that's brilliant. Thanks very much, Andy. I think you managed to actually bring home the story quite nicely for being the last speaker in the lineup. I think just one thing I must commend you and your team on is just understanding your portfolio holdings so well. And actually, recently, your colleague Anne Burgess was explaining to us how one of your portfolio companies are helping to reduce myopia in children. I think that's really fantastic. But for today, I wanted to ask you just to share some of your thoughts on the Metaverse for us, please.
Yeah, so oh my days. So this is really interesting, and it's something we're watching. Obviously, Microsoft's bid for Activision recently it is likely to be because they want more stake in the metaverse. Obviously, Facebook have said that they're investing a huge amount in the metaverse, and it's one that it's an area that we are doing some work on, and it's too early for us to invest other than through major companies like Meta and Microsoft. But I can understand it in a way. And in a way, when you think about it, it means that things like NFTs are probably or possibly not as crazy as I originally thought, because there are a large cohort of society who are young, can't afford to get on the housing ladder or the property ladder, living typically in rented accommodation that is small, and they are the ones who very possibly will want to spend a lot of time in the metaverse. So in the metaverse, instead of living in a dingy flat in the middle of, let's say, Manchester, they could own a mansion in the metaverse, right in the middle, and they're going to interact with other people, and so this idea that historically people have, in capitalist societies, people have generally always wanted more. So if you ask people if they like a nicer house, most people would say yes. If they want a nicer car, most people would say yes. But maybe those displays of wealth in the future, maybe they're displays of wealth in the metaverse, and that you end up living your life through virtual reality headsets or something similar in the metaverse. And so I can kind of understand it at its basic level. I think there's a long way to go. So I think it's one of these things that we will have plenty of time to see how it shapes up, and if there are, good business models within the metaverse that will be cash generative. And I suspect if there are, they will be advertising related somehow. So we've seen obviously Facebook and Google, probably the two best business models that have been created as a consequence of the internet in the 1990s and 2000s. Those two business models are both advertising related, and it's likely that anything in the metaverse that ends up being a very successful business model would again be advertising related. So we're keeping our eyes open. We're trying to learn about the metaverse, but it's not something that we're likely to invest in. And it strikes me that if it follows the shape of other, I guess, fads, then what we'll see, we will see a massive equity market bubble in metaverse companies, and then a crash, and then after that, the ones that actually have a viable and potentially successful business model will then take off. But it's likely that we'll have some sort of up and down first if we follow things like the internet or other areas that have done similar, all the way back to railroads in the early 20th century.
Andy, that was brilliant. As always, you never cease to disappoint. So thanks very much to you and your team. And yeah, we're very appreciative of having you here today. And we will chat soon.
Well, thank you very much to everybody, and to the holders of the fund. Thank you very much for obviously for holding the fund. And I think the next 5 years will be very interesting. And I think if looking at valuations, I think if anyone can achieve kind of high single digit, low double digit annualized rates of return for the next 5 years, I think that will do extremely well, because I think we might be in a fairly difficult environment. But thanks, Anil, for the opportunity to talk to everybody.